All right, today we're diving deep into Opendoor Technologies. You've probably seen the headlines. The stock, ticker OPON, just had an absolutely monster day. But the charts, well, they're telling a fascinating and kind of conflicting story. So let's unpack it all right now. So first things first, let's talk about that headline number. Opendoor shot up over 13% in just one session, closing the day at $7.97. Now look, a gain that big is always going to turn heads, but it's what's happening underneath the surface that really tells the tale. And this wasn't some quiet move, not at all. This rally had some serious muscle behind it. We're talking over 207 million shares trading hands. To put that in perspective, its recent average is closer to 124 million. So yeah, this wasn't a slow drift up, it was a stampede. And that tells you there's some major interest here, from big institutions all the way down to retail traders. And that, of course, brings us to the million-dollar question. Is this a real breakout, something with legs? Or is this a classic bull trap, just waiting to snap shut on unsuspecting investors? Because right now, the technical indicators are telling two completely different stories. Okay, first up, let's make the case for the bulls. Why could this rally be just the very beginning? There are actually some really powerful signals suggesting that a solid foundation has been laid here. To really get the bullish argument, you gotta understand moving averages. Now, think of them as a way to just smooth out all the crazy day-to-day price noise. By averaging the price over a certain period, say 5 days or 50 or even 200, traders can kind of ignore the static and see the real underlying trend. And wow, this is where the bullish story gets really compelling. Just look at how dominant that current price is. At nearly $8, it's floating comfortably above all of its key short-term averages. That shows a ton of recent strength. But the real kicker? Look how far it is above the long-term averages. That 200-day average is way down at 265. That just shows you how incredibly powerful this trend reversal has been. So what does all that mean? Well, essentially, this isn't just a one-day pop. The data is screening that this is a bullish breakout, and it's being supported by a really solid long-term base. Honestly, this is the exact kind of setup that trend-following traders dream about. And it doesn't stop there. The stock is also hanging out above the middle line of its Bollinger Bands, which is sitting at about 779. Now, in the world of technical analysis, that's another textbook sign of bullish momentum. It suggests the buyers are firmly in control. So, yeah, the bull case looks pretty darn solid. But, and this is a big but, there's a whole other side to this story. So let's flip the coin and look at the bearish case. Because while the price action looks amazing on the surface, some of the key momentum indicators under the hood are practically screaming for caution. Our very first red flag comes from an indicator called the MACD. All you really need to know is that it's designed to show changes in the strength and momentum of a trend. And when the MACD reading is negative, it's often a sign that downward momentum is starting to build up. And here is where the plot really thickens. Even as the price was soaring more than 13%, this key momentum indicator, the MACD, was actually negative, and it was pointing down. That, my friends, is what traders call a bearish divergence, and it is a major red flag that suggests this huge rally might just be running on fumes. Okay, next up, let's talk about the RSI, or the Relative Strength Index. Think of this like a gas gauge for a stock's momentum. It helps traders see if a stock is getting overbought and maybe due for a cool down, or oversold and maybe ready for a bounce. Now, this is where it gets a little nuanced. The standard 14-day RSI is just kind of neutral, no big deal there. But a much more sensitive, short-term version of it, called the stochastic RSI, is pegged at 100. That is its absolute maximum reading. It's basically flashing a giant neon sign that says severely overbought in the very short term. It hints that this rally might be totally exhausted and the buyers are just about out of gas. So what we've got here is a classic technical tug of war. You've got this beautiful, bullish price action pulling in one direction and these tired, bearish momentum indicators pulling in the complete opposite direction. The only way we're going to know which side is winning is by watching the key price levels on the chart. And this slide right here, this lays out the entire battlefield. For the bulls, the mission is crystal clear. Smash through that resistance at $8.49. For the bears, the prime target is that critical support level at $7.34. Now, if the price breaks below that floor, it's a huge win for the bears. It could open the door to a much deeper slide, maybe down to that next support at 643. These are the lines in the sand. And we can't forget the bigger picture here. For one thing, volatility is high, and that just cranks up the risk for everybody involved. At the same time, the indicators that measure trend strength, they're still pretty weak, which tells us this new uptrend isn't really confirmed yet. It all just paints a really messy, really complicated picture where both sides have a pretty compelling argument. So, after all that, what's the strategy? What's the play here? Let's put all the pieces together and see if we can form a clear game plan based on everything the data is telling us. It really just boils down to this. The whole bullish story depends on defending that $7.34 support level. If the stock can hold the line there and then push higher with strong volume, the next logical target is that 849 resistance. The bearish case is the exact mirror image. A decisive break below 734 would completely invalidate the breakout and would almost certainly trigger a wave of selling, probably down towards 643. And that's really the final takeaway here. On one side, you have this powerful, volume-driven surge in price. On the other side, you've got these exhausted, negative momentum indicators. It is a textbook standoff between price and momentum. And how it gets resolved will very likely decide Opendoor's next big move. The only question is, which side is going to blink first?